126 trillion the equity market in the world. And so can you imagine the efficiencies that can be wrought from bringing this on chain?
It was about how can I transfer value to you without the man being involved.
Yeah, all of this stuff out there, and out there is City and Wall Street, would come and sit on top of blockchain.
Wall Street's very much like, we don't want to get involved with that. No. The law is catching up.
Welcome to The Local. It's Marcus and me again. We haven't done one of these for a while where we talk about stuff that's going on.
Our relationship's been open as of late.
Yeah, we've had other people in the room, which has been great.
It spices it up.
It spices it up, keeps it fresh. We wanted to get back in and talk about...
Not financial advice.
All the stuff that's going on, not any type of advice. Because we haven't done it for a while. And we like talking about the markets. We like talking about what's going on in digital assets, but increasingly just in finance, right? Because that's a change that's happening for us as a firm and I think for the industry. Right?
Yeah, definitely. I'd agree. No, it's something that we kind of probably bet on.
Yeah, I mean, that's part of the premise of low tech was that all of this stuff out there, and out there is City and Wall Street, would come and sit on top of blockchain rails. I
guess we're probably actually the people that some people in crypto hate.
Yes, there's definite part of the, I think, feeling down elements of crypto at the moment is because they see adoption happening, but not in the way that they necessarily want it.
Yeah, exactly. Yeah.
Which I have some sympathy with, but because it's the way that Wall Street's using crypto is certainly not decentralized peer-to-peer sovereignty. No. It's a use of a good technology to do other stuff.
Instant settlement transfer, right?
I mean, I also think that it'd be interesting to get your opinion on this. I also think that the original white paper was about exchanging value between people. And so it's implicitly always kind of had this financial element to it.
It's a bit weird, isn't it? Right. It was always meant to be money. Right. So, and Wall Street and the City are about money.
Yeah, and then to get pissy that it's being adopted by people
who's raison d'etre is money. Yeah. Like I think is like one of those things. But yeah, it was. Of course, it was because I mean, it was. What was the one before? B Gold on B Cash or whatever it was called. Yeah. So I mean, it was always this implicit, and it's got coin in the name, right?
Yes.
Because I always think this like,
that's true.
It's a little bit I've said this before. It's a little bit of a retrospective to say, oh, it's about digital gold and it's about assets and it's about an inflation hedge. No.
Or even distributed computing.
Yeah. It's bullshit. It was about how can I transfer value to you without the man being involved. Yeah. And it just turned out that the first one, the technology wasn't that good.
Right.
6 transactions per second or whatever it was.
Yeah, exactly.
Turns out, after 10 years, the technology's
capable,
quite a bit better.
Yeah, and
15 years.
A lot of smart people working on it to the point where it's now being used in production to support all sorts of stuff. I should have said, what are you drinking? We're not drinking pints. What are you drinking?
It's because it's 9 o'clock in the morning.
But it's rare when we're in the pub.
We have drank pints at 9 o'clock in the morning, though, and made it look like it was
zeros only. Yeah. That was the old studio.
I mean, maybe because it felt like we were out of the office, Okay. As you said earlier, if you're not in the office, you're not in the office working, what you do, you're drinking.
Yeah. But that point about the adoption sort of brings me on to one of the big things that's in the news this week is around the SEC announcing proposed rules for tokenization of securities. And so this, again, is part of that trend that we're getting from the US now around good, fast regulation, giving clarity and allowing the industry, both the crypto industry, sort of the institutional elements of it, and Wall Street / the City.
It's like giving Wall Street confidence to, because 6 years ago when there was a unfriendly administration, Wall Street's very much like, we don't want to get involved with that. Are we going to get fined?
And people weren't building in the US as a result.
Exactly. And so now obviously it's friendly administration and sensible regulation.
Yeah. And moving quickly.
Of course, Wall Street wants to take the bits that are value to it,
Yeah, which again, and possibly why the crypto communities are a bit sore about that. But SEC is out.
Some parts of the crypto community.
Yeah. Others, I mean, I think if you're trading related and finance related, you see the benefit, and you've probably been eulogizing about the benefit for a long time.
Yeah.
And to see it being adopted is
that Eulogising? Eulogizing.
Eulogizing about it, yeah. It's definitely how it's pronounced.
It's not.
So the SEC are out. They've got proposed rules around tokenization of assets.
Okay. But tokenized stocks already exist?
Yes, but this is something that I think is worth talking about. We've seen tokenization, but not in its sort of purest format And so the stuff that's out there with examples like Kraken's backed tokenized US
But
equities.
what was the one that was ages ago? Synthetics.
Oh, synthetics. So I remember we looked at synthetics a lot, but I can't remember what the structure was. But the interesting thing about tokenization as it's being used currently is that it's a huge sort of jumble of mechanisms to get backed securities, so securities that are placed with a custodian on-chain.
So that is, for me who's a layman, the share certificate that you can have, which shows that you really, really physically do own. Own?
No, that's interesting, right?
So
in the backed and Kraken example, shares will be placed with backed, and they will issue a security on chain that represents those shares. The shares then will
are they redeemable?
The shares then will sit with a custodian. But you miss out on certain things, like you don't have, I think, certainly most wrapper tokenizations. And I need to get the details on the backed Kraken one particularly, but you don't have voting rights, for instance, as a result of owning the on-chain asset. You don't receive dividends as a result of
that's obviously a big issue as well, right? Because if your stock's publicly traded, when it goes ex-dividend,
it's price moves.
Yeah, but also, and it's usually offset by the fact that you're going to get paid. So if you don't get paid,
exactly. So that
is categorically worse.
That wrapper mechanism is interesting, but it's been used a lot because within the less favourable US administration, that was acceptable. It was similar to a lot of ways that other mechanisms works, like ETFs, for instance, go and gather a load of assets that are the actual thing, and then issue
the kind of actual thing,
and then issue a share that represents that.
Because what do they actually do? It's not when you get an S&P ETF, they're not actually holding all 500 stocks.
It depends on what type it is.
Yeah.
So you can get authorized participants who will go out and deliver all of the component shares to the issuer of the ETF. The issuer of the ETF will take in those shares and like mint out wrong language, or issue a new ETF. Yeah. There are others where you can do it synthetically.
Yeah, I'm going to say, because I thought that basically if you want to track the S&P 500 as your ETF, if you want to get a 99% tracking accuracy, you only have to trade 30 shares rather than
30 shares or go and trade a future.
Which
will track the underlying exactly minus rates and divs. And so it's a similar mechanism with the majority of the tokenized equities that have gone out there.
This is the old world.
This is the current. This is the current world. There's just two flavors of it. There's wrapper tokenization, which is what this is, which is the share actually sits in a custodian somewhere that has a relationship with the issuer. In Kraken's case, it would be backed.
And what's the relationship the issuer has with the actual company?
The company with the share?
Yeah. So if it's an Apple one...
Yeah, nothing. They just hold the share.
They just buy it from the open market then?
Yeah.
Right, okay, yeah.
And then the thing that they own and issue is the on-chain asset.
Right, okay.
I think the backed ones are on Solana.
So basically, it's a kind of like, like stablecoins.
Yeah.
It's a great money-making machine because
you
issue $1 and then you buy US treasuries and you get 5% for nothing.
Yes.
Other than the fact that you own a technology.
Well, that's something else we're going to talk about.
It's the same with the equities, right? You issue the tokenized thing, don't get any dividends, don't get any voting rights. Yeah, I'll go buy the real stock and I'll sit and get all the divvies.
Same play.
And
we got more to talk about in terms of interest on.
Sorry, I hadn't got there.
Now that's rapid tokenization under current and existing and going forward regulations. I'd imagine it's fine. It's a mechanism that's been used in lots of different parts of finance. Securitization, similar, gather assets, issue something else, and. There needs to be sort of clarity from the US around how they are going to approach this as it moves more wholeheartedly into equities and the plumbing that sits underneath equities, which is where the win is in terms of blockchain, by taking settlement from a couple of days down to zero or instant. Although having been at a conference last week, there are people that say there's no need, which is interesting in itself.
So what people who say it's all overblown, nobody gives a shit about settlement?
No, it wasn't quite that strong. And I'll get onto that in a second. But the other flavour of tokenization, which is where sort of bigger, or maybe ancillary unlocks come, is when you actually issue the security on-chain natively.
Right, okay. So that is a company turns around and says, our share certificates are these NFTs.
Yes,
not
exactly.
NFTs, they're
our
fungible.
Equity is this on-chain token. And there's no other security that sits anywhere.
Right, okay.
And then that is pure sort of tokenization.
But then that surely you're getting really into the weeds of like what legal title and
what an asset
is.
It needs its own sort of. It needs bringing into the regulatory regime.
Does that kind of go where sort of the US government weighs in and says EIP 1337 smart contracts are the equivalent of share certificates?
I guess so.
Or something. Is that where there's is that the case law where somebody says that at this standard, the common law jurisdiction, they're going to have this. You need to have this precedent.
Yes,
and they said that's the test case. And as soon as we've got that standard is the thing,
exactly,
it can actually be issued on chain.
And so. Certainly, the sandbox in the UK was looking at tokenization in those terms, in terms of if you're going to create a new asset, it goes purely on the blockchain. The issuing entity is blockchain based, and it issues out straight onto the blockchain, and that is the only asset. There's no sort of one-for-one backing at all. Obviously, it doesn't quite fit into the current structure.
But it does. It enables a whole.
Yes, this is
we're planning because then if you're trading a tokenized stocks exchange,
you don't need the custodian sitting here passing things back and forward, and
there's no wrapper required.
And I mean, this was part of the pushback in the conference room that I was at last week, was that you've got in the wrapping setup, you've got two settlements anyway. You've got the on-chain settlement, and then if it's going from one custodian to another because the owner of the on-chain asset wants it to be somewhere else, you've still got a settlement process which is possibly taking days being mirrored, this shadow second rail.
Days, I mean, like when you ever move any of these things between brokers, it's 6 weeks.
Right. Yeah. So not ideal, and not the purest realization of the benefits of the blockchain. And then there's the second sort of side to it as well, which is if you want to have pure atomic settlement, you need both assets, the asset leg and the sort of fiat leg to be on chain, because then you can genuinely have your blockchain issued share and my stablecoin.
Are we not just going to call them tokens?
Maybe, I don't know.
Like, is a blockchain issued share not a token? Because I mean, a token is a generic term for many different smart contracts, right? You know, like we mostly, in my mind, I mostly think of things that are maybe like ERC20 compatible or something, or equivalent on Solana. It sort of just becomes a new one of those, right? Where it's got this like legal title to it.
I guess, I mean, if you're doing that as the way to divide up ownership of your company, maybe it, technically it would be called a token, but like legally it might be called a on-chain share, or I don't know. For other more important things to describe.
Like where's the actual difference between what people are talking about there and having something that just launches a token on chain that people can buy and it's the money flows to the
it must flow back to the ownership, right? So I mean, we know that a lot of projects have issued tokens over the last 10 years, but it implied no ownership and had no direct ownership of the underlying or the IP or the thing that the company was doing.
And there was, so it's to do with the administrative functions that are on the smart contract, I guess, or something. Like because companies that have issued tokens, they could burn them and mint new ones and all this kind of stuff. So it's about the protections that come into that. Like you can issue new shares, but there has to be a board resolution to do it or something.
It gives you claim associated, like in the same way that equity, when you issue equity out of companies.
So it feels like a lot of these things are kind of like already kind of exist on chain, like governance tokens,
the mechanisms,
mechanisms,
for sure,
all this kind of stuff. It just seems like the law is catching up.
The law is catching up, which I think is what part of this SEC stuff is beginning to make steps towards. Because I think from an equities perspective, as long as you have these dual rails of you and I can trade the Bax Kraken versions, but still there's this one-for-one thing that's sitting in a custodian somewhere. It might feel incredibly efficient to you and me. But there's still this mechanics that's flowing in the old world. A custodian, actual assets that might need to move around between people. Whereas if we remove that by issuing the shares natively on a blockchain, and then I sell my Apple share to you, and it's a tokenized version, then there's none of this other stuff that has to happen.
It's a bit. I suppose it's a bit more like I view it coming from a lens of like it becomes more useful if you want to move where you hold your ISA. Or your ETFs, your brokerage account, where you hold these things. Because when it's not quite, it would be really nice if the technology was there and the confidence was there that actually I could buy my S&P ETF in an ISA wrapper, but I just couldn't got it on chain. And so I hold it with that provider, and then actually I'm going to move it to that provider because I want to change I want to trade it out a little bit.
Or they offer a different type
of flexibility or whatever, or the fees are different, or if I need to trade in that platform so I don't lose the tax shelter and this kind of stuff. It feels like that would be the big win.
Yeah.
Because I mean, incredibly frustrating whenever you want to. What was I lamenting the other day? I sold something and it was like a 2-3 day settlement before I had the cash to be able to get into the position. I've traded one ETF for another ETF and it's like 3 days before I can do it.
And if you imagine you're doing that, I mean, obviously your size is huge size. But if you're
and what about the trade?
if you're doing that in an institutional setting,
I mean, I'm talking about a few grand here and there. You know what I mean?
2 or 3 days of like millions of dollars being sitting,
billions, and sometimes as well.
Yeah, exactly. Yeah. I mean, was it 126 trillion the equity market in the world, and so can you imagine the efficiencies that can be wrought from bringing this on chain? And so I think the SEC news.
And the edges that are going to go away.
The edges, the intermediaries in the middle.
Because that trade executes in my brokerage, and my ETF becomes cash, and it sits there for 3 days. Somebody's earning yield. Somebody's earning yield. Yeah. Someone's getting the overnight rate on that.
Yep, for 3 days.
And it ain't me.
That yield point, the interest rate point, is interesting in relation to the news that's coming. Slowly in relation to stablecoins in the US, because the big bun fight in stablecoins and the big resistance that's been from the banks is being able to pay interest, or who receives the interest. Because as we mentioned earlier on,
that's nice. Best business model in the world.
It's such a good business model. Well, in a positive interest rate
I receive $1 plus interest. You receive code.
Exactly, or $1.
Yeah. Well, whichever you believe. Yeah, honestly, it's backed 1-to-1.
I mean, and obviously, as interest rates have climbed over the last few years, this has become a bigger.
But because I've seen, for many years, I've had pictures from people who are launching new stable coins or wallets that want to provide. You know, people have been looking at this thing of like, well, you know, someone's earning yield on your dollars.
Somewhere is earning yield on.
Well, we know who it is. It's Circle and Tether.
Yep.
You know, they're earning this yield, and we would like, you know, markets get more efficient over time, right? So eventually, somebody will win by saying, well, I'm going to give you back 5 bips. Then you get 10 bips. And before you know it, it'll be as efficient.
Someone will be doing
it'll be as efficient as a savings account.
And the big resistance, I mean, in my mind, you always looked at the money and the incentives. The big resistance has been from the US banks. Yeah. Because their worry is that deposit flight is a real thing. So as soon as like the stablecoin issuers start having to through competition, putting yield on top of the assets or into the assets, or going, okay, I've been earning 5% on this billion dollar set of deposits I've got. Yeah. Maybe I'll sort of carve off 10% and give it to the actual, the issued token. The worry is that becomes very attractive for people, and so the banks suddenly have a competitor they didn't have before, who is also potentially way more efficient.
That's all the bank's business model is.
Yeah. Take deposits in.
I'll take the deposits in. I'm going to lend a bit of them out. I'm going to buy some treasuries. I'm going to think, that's how the Silicon Valley Bank got fucked, right? They were bought, when yields were 1%, and then and you get 5%, and
curve risk is
everyone want their money back to be able to deposit into the higher yield.
I still remember one of my parents, I think it was my mum, explaining to me how banks work for the first time. And it was exactly that. It was like you put your money in there, and they give you.
You don't even put your money in there.
And they
write a number in a ledger. Yeah. They don't even put any money in. They have the ability to create it.
What is money?
Yeah. But it's just a ledger, right? When you go to Halifax and you want to get a mortgage, they don't have to get that £500,000 in your size, 20 million quid from.
This was 5-year-old me actually putting money into a bank.
Physical coins.
Yes, it was.
Yeah.
My NatWest Globe. It's very cool. But yeah, this is the big bun fight in the US, and I think it's moving. Whereas
so surely that just brings the capital controls and the stress testing and all the stuff that banks got. I suppose stablecoin issuers, are they lending it out yet? That's gonna be coming soon, right? Surely.
I think there's been a lot of scrutiny as to where and in what assets the balance sheets of the issuers, particularly Tether, have been placed, because it's
cash and short-term treasuries.
It's not purely treasuries, right? I think they've been open in saying that.
Some corporate debt is there as well.
Well, it's tricky to. I mean, I haven't looked at it in huge great detail, but obviously as a business they've made a lot of money over the last. When did it start? 15
years ago.
10, 11 years. Yeah. And so there's obviously retained earnings that they begin to do investments with as well. And so I think there's probably a mixed perception of like, these guys are doing stuff really risky, and it's actually, no, that's money they've earned effectively. There's nothing to do with the actual current deposits and the yield.
Yeah, but hopefully you'd think that there was a...
Oh, well, you'd hope so, but...
Hong Kong firewall or whatever it is between those two things.
Chinese wall.
No, I know it's a Chinese wall, but isn't it? Aren't they in Hong Kong? was doing a joke. It made you laugh.
It did make me laugh. And so it's advances in the Clarity Act that are bringing the stablecoin yield problem to the fore. In your opinion, do you think? I mean, if you hold some USDT or USDC, should you, as the holder of that, be entitled to yield that might be being earned by the issuer?
Yeah, I don't know. It's difficult, isn't it? Because you're not entitled. You hold sterling. You're not entitled to the UK gilts yield, right? You have to choose to invest in it, right? You have to, exactly right. So I do think if it is truly dollar on chain, then maybe you should go and find your own yield at the risk level that you're comfortable with. Because it's not. People think, oh well, they're just buying treasuries and earning yield. It's like, well, no. You've got to have a strategy about what treasuries you're going to invest in, what maturities you're going to hold, are you strip and blah 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 blah. And I'm not a fixed income guy at all, but like this,
if they're purely holding cash, they're not earning.
They're not earning yield, right? So,
which is a strategy in itself.
Are they taking on the risk? There is risk associated with buying treasuries, right? We call it the risk-free rate.
No, it's credit.
It's credit, right? There's credit risk there, which is why you're getting paid.
Yeah,
and so maybe I'm comfortable with that's a business who's taking some credit risk with their, as long as they've got the balance sheet to make you whole if their trade goes wrong, which obviously didn't happen with, say, SVB, where they had to be backstopped by the government. I think that's where the issue comes for me. It's a bit like, well,
how aggressive do you allow the issuers to be?
I mean, like, and
what to your point, what regs do they fall under?
Yes,
if they begin to act like banks, do they have to come under the sort of same regulatory scrutiny and reserve ratios?
Stress tests and reserve ratios and all this kind of stuff, and it depends on what they're doing. Like, because I imagine probably there's a lot more dollars in. I don't know the stats, but I imagine there's quite a lot more dollars sitting in what basically, if there was a run on USDC to get USD out, I imagine they would find it easier to handle than if there was a run on USD at Chase or JP Morgan or something, right? Because their reserve ratios are what, 10 or 15%?
Normally, if it's 9%.
Exactly right.
Yeah.
So if somebody turned around and went, only 9% of USDC is backed by cash,
people would panic.
People panic, right?
Yeah.
But like, so yeah, I don't know. I don't think it's an easy question.
I hadn't thought about it like that, and that's interesting. In that you think, okay, if I've got literally £1 coin or $1 bill in my pocket, I'm not earning yield on that.
No,
right, and that's an active choice.
That's an active choice. You can go and buy gilts with it.
And so if I were able to give that to Tether or Circle, and they issued me a token, to suddenly switch and go, oh, well, I deserve yield, is a bit kind of weird, particularly if they've just taken that dollar bill in and put it in the drawer.
Now the question is basically, is it the view that you've swapped it for another currency which allows you to buy stuff in a different arena? Because we're also very comfortable with going, here's my pound, give me my euro. I need euro because I want to buy stuff over there.
Yep.
It's the same sort of thing on chain, right? I give you my dollar, you give me my USDC, that allows me to buy stuff there, right? Are they the same currency? Are they not? And ultimately, it comes down to, I don't think they are the same currency, purely the fact because there's an FX rate.
Yeah.
Right?
Which is not
always one-to-one.
Yeah.
Now, Circle might guarantee one-to-one.
Yeah, and I think if you get to
some stress test and whatnot, but I think it's right on the edge of whether or not it's a pegged currency that has its own
sort of utility
and risk and whatnot. You can buy baguettes with euros. You can buy baguette token with USDC. So
what else can you buy with euros?
I don't know. Try not to
just baguettes.
Try not to have them.
Okay, and stablecoins in the news in the UK as well because the Bank of England are walking back their incredibly conservative
stupid rules.
Oh dear!
We're just a bit of a laughing stock when it comes to. I get it. I mean, I suppose.
I don't know if we're a laughing stock. We're just incredibly conservative and now categorically behind.
It's like cultural, isn't it? Cultural, like in the US, take risk, gung ho. It doesn't matter if you go bankrupt; it's fine. Whereas in the UK, it's like so conservative that if you're a genius, you've really won in life if you go be a lawyer and earn 150 grand. You know what I mean? It's like that kind of thing, which is just a cultural thing. Now, maybe in time, large institutions and big players like the conservatism, but I don't think that really the 20k stablecoin rule for retail is.
Yeah, and it's not just that; it was sort of the even the carve outs that they had for institutions got a lot of pushback as well.
Yeah, exactly.
And I get it. FCA regulation in general has always been pretty much a gold standard.
Is it up there with the SEC?
Yeah, for sure. in terms of like
parity.
I think so. Yeah. Obviously, there's the subtle impacts of like people prefer to list in the US because the buying market.
Yeah, but also, but people prefer to have the governing law of their contracts be English law,
right?
Because you can bring many international cases where the companies are not coming here because we have so there
are tensions. But I think the FCA's regulation in general has been perceived to be very well. But I think similar to post sort of financial crisis, those banks that survived. Looked at themselves and said, "Oh, we survived because we were so conservative and slow moving." Then there's possibly a bit of that creeping into the way the FCA is behaving now. So let's go so conservative and be measured about this and be prudent, and eventually the regulation will get to a point probably where it's very good. Yeah, but you'll have lost all of the innovation.
All the innovation and the business, right? Yeah, exactly. And I suppose they've been quite. The risk is to try and view finance as like a utility. I think what they did post financial crash was they basically tried to make the banks utilities, where they were so heavily constrained in what they could do, that essentially if the bank, wanted to innovate and say, the analogy that was given to me by a very senior guy at hedge fund said, the utility companies could, if they wanted to, say, we'll install a new line in your house that brings Coca-Cola into your house, and nice. you can have that in your, you can water company you could have that, and you get a tap of Coca-Cola, and that would be an innovation where you might pay an extra fee for that product, where it's kind of like a thing, but obviously they're not allowed to do that, right? They have to deliver
pure water,
and that's it. And so like with the utility, the water company is kind of constrained in how it can innovate its product base,
and the banks probably feel very.
And
similar.
The banks, I think, post 2008 in Europe. This was kind of how they were viewed, like you will offer these sanitized pure products.
This in, this out.
And
within that constraint.
And that's the constraint. Yeah. And so like they don't have the space to innovate like that. And so it's maybe buttressing up against the fact that, now you've got these things that are maybe competitors to banks, and the FCA are looking at them and going like, it feels like a bank, and like, what are these things? Or we've got this 20-year history now of the fact that this is just, all they can sell is pure water. So.
Let's kind of think about how to approach this innovation area with this.
With this utility in mind.